Hello, everyone. We're back for our quarterly market update. And as you can see, we're doing the same format that we did last quarter, where it's just me and Meghan chatting about the market and the world. We got some really good feedback from you that you like this format, that you thought it was informative and educational. And please continue to give us that feedback. Our mission as a firm, it's really to empower all of you to be better investors. And we do that, it's through educational content like this that hopefully builds your knowledge and makes you a more confident investor along the way. So all that being said, Meghan, a lot to cover, right?
Couple things, just a few things happening in the world.
A lot. This was by no means a boring quarter. No. So can you cover some of the big things that happened?
Yeah, I think again, there's a big laundry list of stuff, but coming out of 2022, inflation was still a hot topic coming into this year. It has definitely moderated, but it is still meaningfully above, I think, where the Fed and all the government officials want to see it long term.
Yeah, it's in the call it 4 to 5% range right now, right?
Exactly, and still at a level, I think, that's impactful to people in their lives. So it's, again, a little less scary, but still a big issue. And then the follow-up big issue to that is, what is the Federal Reserve or the Fed doing about it? So they've been on the most aggressive rate hiking cycle in history, in terms of speed, right? Very, very quick to raise rates and get back up to, from zero, up to a more moderate level. And so now the question very much in the focus of the markets is, are they going to continue raising rates? Are they going to pause and wait for a while? When will they lower rates? So that dynamic really has a big impact, I think, on markets and how investors are thinking about the world. Then on top of that, you had bank failures. So that was something that I think surprised at least the mainstream pretty dramatically, where
they virtually came out of nowhere too, so quickly.
It seemed like it just kind of happened overnight, right? It wasn't that you were hearing about it for weeks and weeks, all the problems. It was just all of a sudden, you had banks failing. And then on top of all of that, there's the debate of will there or won't there be a recession? And a lot of those recession indicators, warning signs are flashing red, but still, we're not in a recession yet, so it's still something of a question.
Let's spend a little bit more time talking about the Federal Reserve. We've spent really years being actually somewhat critical of the Federal Reserve. Their zero interest rate policies, their money printing, that we thought there would ultimately be a cost to these policies, namely in the form of inflation, which we are now seeing. All that being said, they are in a really tough spot right now. I am empathetic to the situation.
Wouldn't want to be that.
Yeah, they're really backed into a corner because, in essence, they have two mandates. One is to keep stable prices, i.e. keep inflation low, and the other one is to promote financial stability, really, which is generally in the form of keeping employment high. The problem is those two things are counter to one another, and we're seeing that in the current environment where we have high inflation. And as a result of that, what tool are they using to combat that? They're raising interest rates. The problem is, and you alluded to it, the speed at which they raise interest rates is counter to promoting financial stability. We think a big reason why we're seeing potential recessionary indicators, but more importantly, financial accidents, like we saw with the bank failures, is because of the speed with which they raise interest rates.
Right. Yeah, I think that's the case. And I think it comes down to, back into the bank crisis for a second, how do banks make money? And so this is something that I don't think is actually that widely understood, even though obviously banks are an essential part of our economy. People have probably heard now the word being thrown around, the fractionalized banking system.
Yes.
So the idea being that if someone puts $100 with a bank as a deposit, they don't just sit on that $100, they're trying to make money on that. So the way banks make money is they take 90 of the $100 and they are lending that out, or they're trying to make money on that piece of it.
Hence the fraction.
Exactly.
So 10% in essence they keep on hand and 90% they invest.
Right, and so that 10% is the amount that they have to keep theoretically if somebody wants to come back and ask for their money, right? If you want to click a button and pull your money out. So it's a small percentage of their deposits that they actually are keeping ready to go in case someone asks. So we'll get back to that in a second. But the $90 that they're putting out there, they have to find a way to make a return on that that's higher than what they're paying depositors. So back when interest rates were zero, they were paying depositors zero, but it was tough to find stuff that had a safe yield. And so a lot of what they did was they would lend out money, 30-year type mortgages at very low interest rates, but it was still better, right? If you lent it out at 2.5% or 3%, you were still making something versus paying zero on your deposits. Similar, what the other thing that a lot of banks did was they put money into safe treasury bond. So long-term treasuries that were backed by the U.S. government, and they again weren't making very much. They were locked in yields in the 2% type of range. So now the interest rates have gone up as much as they have. The challenge is that those assets are worth a lot less. So the treasuries are worth less, even though those mortgages are worth less. They have locked in those low returns, and now theoretically they should be paying more on their deposits. So they're in a really tough spot.
So the way you described, and we talked a lot about this over the years, banks in general, it sounds like a very flawed business model, ripe with risk, where we talk about, you might hear the term asset liability mismatch, but that's exactly what this is. Depositors, all of us who deposit money in a bank, we're the liability. We could raise our hand at any time and say, we want our money out tomorrow. The flip side is they have assets to support those depositors, to those deposits, and those assets are invested in long-term things like mortgages and long-term bonds. It's just a real mismatch that causes a problem. And specifically with Silicon Valley, they were in somewhat of a unique position where literally a third of the depositors in one day withdrew their money. It was $40 billion that was withdrawn in one day, just an incredible amount of money. And I think a lot of that caught regulators off guard, partly just because of the new world we're in. And I'm specifically talking about technology. So what I mean by that is most of their depositors happen to be concentrated in Silicon Valley. They were venture capital funds and private equity funds. And a lot of these funds were connected with one another. They knew each other. And they were connected on social media. So once word got out that some of them were starting to withdraw money from the bank, it spread like wildfire through social media. The other aspect of technology, which is really a new phenomenon in the last, call it 10, 15 years, is online banking. So while this happened in 2008 during those bank crises, still, you had to at least log onto your computer or probably call your banker if you wanted to withdraw your funds. Not the case anymore. You could literally go onto your iPhone, put in your password, and withdraw millions of dollars in a moment's notice. So just a new paradigm shift with regards to making banking, we think, more fragile in general, where we think there's going to be changes probably coming from a regulatory point of view that regulators have to combat this going forward.
Yep. And so the Fed, the action that happened in the wake of that was that the Fed stepped up and they basically, they backstopped all depositors. So even if you had more than the FDIC limits, at Silicon Valley Bank, and Signature Bank was the other one that failed, they are saying, don't worry, your deposits are covered, and they're covering that. And so now what you're hearing a lot of is that, well, don't worry, the Fed has the back of the banking system. So this is a non-issue now, like you don't have to worry about your deposits. And I would agree to some degree, there is sort of an implicit guarantee of them saying that, hey, they're going to be taking care of this and covering it. But until it is explicit, I don't think I would rely on it. Everyone remembers back in 2008, the Fed was saving institutions left and right.
They saved Bear Stearns at first.
They were making deals. They were putting things together, basically just backstopping the system then. And then it was like, oh, Lehman goes bankrupt. So I'm sure they had their reasons, but the flip side is that now I wouldn't rely on it that way. I would still think about cash, FDIC limits, security.
One other aspect that I'd like to hit on, you mentioned how these banks make their investments, and to some degree they were forced to take on more risk in a zero interest rate environment. So instead of buying 2, 3, 4-year bonds, they bought 20 and 30-year bonds.
Right.
And just how reckless that was. Something that we've been talking about for a number of years in our portfolios. We have been not been taking on that type of risk. We would never purchase 10, 20, 30-year bonds because we had concerns that when interest rates ultimately would rise, the value of those bonds would get hit very hard. And that's exactly what happened with Silicon Bank. It's kind of shocking the degree to which they were concentrated in these long-term bonds. It just showed an utter failure in risk management.
It's failing risk management. It is a flawed business model. So to some degree, it felt like they were forced into that. They had to try to earn something on it because they have to report to their shareholders on the equity side. So the problem is the moral hazard that all of this creates, and even the Fed's involvement. Because on the one hand, these bank executives, they are not rewarded for being good risk managers. If they don't make enough, if their earnings aren't high enough, then they're gonna get fired basically. And if they do, if they maximize earnings, they're gonna get big bonuses. And then on the downside, well, don't worry, the Fed will bail you out. So that mentality, I think, is really pervasive now, in a lot of places, but in the banking sector in particular.
Right. So they're in essence incentivized to take on the risk because they know the downside. Well, there is some downside, to your point. Ultimately, there is an implicit guarantee they will be bailed out, which they were.
Yeah.
All right. So let's kind of move on to a related topic, cash. A lot of clients, individuals are now thinking about their cash, whether at a bank, whether invested with us. How should people think about their cash balances in general?
Yeah, and it's great because I'm a worrier, so we have this big list of things to worry about. Now let's add cash to the list, right?
Yeah.
That's gonna move to the top really quickly. So I think that FDIC limits, most people are familiar with the concept, so that an individual gets $250,000 of FDIC insurance, and if you have a couple, you could have double that.
So as long as you're below that limit at a bank, you're fine.
Yes, then you have the explicit guarantee now of the government saying that they're going to back those reserves. If something happens to that bank, you're fine. You're going to get your deposits back, and so. Above that, the reality is it doesn't make sense to hold a lot above that. Even at some of these big banks, we'll talk about return in a second, but any bank can have a bank run. And so it's much less likely at some of the big guys. They keep more reserves. There's a lot of reasons, even the whole too big to fail concept.
Sure.
It's pretty unlikely some of the big guys are going to have problems, but it just doesn't make sense. Like why take that tail risk with your cash of all things and have that money sitting there? So for individuals as well as businesses, if you really have a need to keep that money in the bank, there are actually programs out there that help you increase your FDIC insurance. So ICS, Insured Cash Sweep, or sometimes it's covered by the name CEDARS. It's a program where you can have all your money at one bank, so you don't have to open a bunch of accounts, but they will actually spread it out for you to other banks. So technically, the other banks are getting credit for those deposits, and so it's increasing your FDIC insurance, in some cases up to like $150 million. So it's big numbers protection. I think this is particularly relevant for business accounts. If someone's running a business and so they have constant big inflows, outflows, something like that could make a lot of sense. And so that's an option as well if you really need to keep cash at the bank.
Okay, so now let's kind of move on to most of our clients have their investment assets with us, either at Charles Schwab or Fidelity.
Right.
Now, they've both been in the news with all of this that's been going on. But so can you talk about, they have a very different business model, right?
Yes.
Being broker-dealers as opposed to the banking model that you just described.
Correct. So the banking model with the fractionalized banking, that is not the same as with a broker-dealer. Broker-dealers are different, the way that they hold your assets, the way that they make fees. And it's not simple, but fundamentally it is a much more diversified business. They're making fees from a lot of different places. They make trading fees. They make fees that are paid to them actually by the mutual funds or the ETFs that the clients are holding in their accounts. They have different service offering fees. So there's a lot of ways they're making money, a much more diversified business. It's really not them levering up and making all these types of loans within the broker-dealer model.
So beyond that, you mentioned too big to fail. Listen, we're very comfortable. We think we have a high degree of confidence. These are very conservative, secure institutions. But in the very unlikely scenario where a company like a Schwab or a Fidelity did fail, we talk about too big to fail. Yeah. We think the government will come in. I was looking it up the other day. Schwab, the scope of it, over 35 million accounts, tens of millions of clients. Fidelity, even larger, over 40 million accounts. So long story short, we don't think the government would let these institutions fail.
If you're going to label something too big to fail, which again, we're more hesitant to do than maybe others would in terms of relying on that. But again, something that touches this many people, I think would be a tough one. From the effect on the economy, that would be pretty bad if something like Schwab failed. On top of that, there is insurance for broker dealers. So there's something called SIPC, and it basically covers if they were to get over their skis and over lever and do things they weren't supposed to, by their mandate, and they got more aggressive, and they ultimately did go out of business. There is actually insurance to cover people's broker-dealer accounts. And so even in 2008, Lehman had SIPC insurance, and so not creditors of Lehman, but depositors ended up being made whole even with that level of loss. So this insurance is an extra level of insurance there in case these broker-dealers are tremendously mismanaged. But again, with the way that they're structured currently, with how diversified their businesses are, we feel pretty comfortable with where we're at.
So in addition to that, Charles Schwab in particular has been in the news, partly because they happen to also have a bank.
Yes.
So can you talk about that, the bank being separate from the brokerage division, but still a part of the organization?
It is, yeah. It's part of their whole umbrella. So when you hear a lot about what's happening with Schwab in the news now, their bank is not immune from what's happening to banks generally. Again, we made that broad statement that all banks could be subject to bank runs or have issues. I think their bank is in a reasonable shape in the sense of their depositors tend to be smaller on general. They have a lot under that 250,000 FDIC limit. The flip side to that is that, again, same as any bank, I would not keep more than the FDIC limits in that bank. So there is a feature where when cash comes into the broker-dealer side, it does sweep to the Schwab bank. And so it's just a matter of making sure that that stays, under a certain level. If you buy a money market fund, if you buy a treasury, if you buy a mutual fund, an ETF, it automatically stays over on the broker-dealer side and is completely separate from the Schwab bank. So again, a lot of the headlines people are hearing, it's more about Schwab Bank than it is the broker-dealer.
And now, just even from a pure dollars and cents point of view, just from a yield point of view, it makes a lot of sense to be proactive with that, as we are doing and rolling a lot of that cash into money market funds.
That's the other piece of this that is, there's the safety aspect, which is obviously very important. The flip side, the reason why now deposits, I think, are moving out of banks so quickly is that everyone is catching on to the fact that you can make money on your cash now. Yeah. And so it's been like this for a while, but the flip side, it's meaningful now, whereas maybe before if you were going to make 1-2%, if you moved it, it wasn't worth it. Yeah. Now you can make, in government-backed money markets, you can make over 4%. So it's, especially for people where we're talking about larger balances, these are real dollars. And so transferring money to Schwab or Fidelity on the brokerage side, putting them into, we have good systems set up to go ahead and put those into short-term treasuries or into money market funds, again, government-backed. And we'll talk more about investment opportunities broadly, but now it makes sense to do something with your cash.
Okay, great. So let's shift topics, talk a lot about banks, talk about cash. I think we're going to come back a little bit to cash and bonds in a minute, in a little bit, but let's talk about stocks.
Yep.
So after a tough 2022, in the last quarter, stocks had a very strong quarter.
Yep.
The S&P 500, which are large company stocks, was up, I believe, a little over 7%. Smaller companies, while not as strong, was up roughly 3%. And then international stocks were up close to 9%. So really a very strong quarter in the first quarter of the year. With all that's going on, talked about higher interest rates, inflation, and now even bank failures. Why were stocks up so much in the last 3 months?
It's a tough environment, but stocks are celebrating that, which we'll get to in a second. But to some degree, I think it feels a bit like a relief rally. If everyone remembers, stocks were down. The large company U.S. stocks were down 18% in 2022. And so now it has somewhat rebounded from that low. But the flip side is that there is definitely a phenomenon that's happened. And it's not just now or last year. It's actually been around for a while where bad news is good news. And so it's related to the economy or inflation. Numbers come out where things are worse than expected. And the thought is that the Federal Reserve will now have to pause or lower interest rates faster, and the stock market likes that. And so you literally have gotten days where it's a bad jobs report, whatever it is, something negative comes out, and the stock market rallies. Or the reverse, where you get something where it's a strong jobs report, something positive happens, and the market goes down.
And that's actually what we had in late January. The market really rallied in January on bad news, and then there were some strong employment reports. It was at the end of January, and the market sold off because of the strong employment reports. It's counterintuitive.
It really is. Yeah. And the bank stuff, too, you would think, again, the banking crisis, this was not a small bank failure, so it feels like something is wrong. In the past, you would have expected meaningful market sell-off related to this. But again, I think the more prevailing thought process was, okay, now the Fed is going to have to pause and lower rates, and the market actually finds that to be positive.
Yeah, it's a tough market to navigate, not fundamentally driven. Another example of what we think why this is not the sign of a healthy market rally is the narrow leadership. So what I mean by that, typically if you have a healthy market rally, you hear the term breadth.
Right.
That would mean it would be widespread, where a lot of stocks were doing well. That has not been the case in the last 3 months. The stocks that have been performing very well, it's been very concentrated, predominantly in high growth technology-driven names. So specifically, it was actually 3 names in the S&P 500, Apple, Microsoft, and NVIDIA, huge technology company that drove 90% of the returns in the S&P 500.
Yeah.
So literally, basically, without those three stocks, the S&P 500 was literally flat.
Yeah.
Many sectors were negative in the first quarter. Healthcare, financials, utilities, energy, 4 big sectors were all negative. So again, the fact that only a handful of stocks were really up, driving those market returns in the first quarter, not a great or healthy sign.
And we're at this point, we have some stock exposure. It is low because of our concerns for a long time. It's been lower for us and definitely lower versus others in the industry. I think going forward, we are looking at this and saying, okay, the market is it's not cheap. The valuations are. It's better than it was, right? Last year was a tough year for the market, so it's better than it was, but it's still not at levels where we would be excited to buy in from a fundamental standpoint.
Right.
And the problem is, if you do have a recession, there could be challenges ahead. In a typical recession, I think earnings fall in 10 to 15% on average, and that's the average, right? So it could be more, it could be less. But then, in bear markets, stock markets typically have a tough time during recessionary periods. The average, people think of a bear market as 20% down because that's where it starts, but the average is closer to 35% down. So it makes sense, I think, to stay. It's not that we're running away from stocks, but to stay cautious. We don't think there are compelling reasons to add meaningfully at this point.
One other aspect that gives us some pause and reason to be more on the conservative side than not are interest rates. Typically, when you have a tough earnings environment or potential recessionary environment, the Fed would stop raising rates and, in fact, if anything, lower rates. And we'll pull up a chart to illustrate this point. And basically, what this chart shows, this goes back to the mid-1980s, and the blue line shows the growth in earnings in the S&P 500 year over year. And anything above that horizontal blue line, which are most of the data points, shows positive growth in earnings. And occasionally you can see during recessions, earnings went negative, those dips below that horizontal line. You can see where we are here at the far right, that earnings are rolling over and potentially turning negative. So now let's look at the yellow line. The yellow line shows the Federal Reserve and interest rates during those time frames. And not surprisingly, and we'll highlight these areas here, during each of the periods where earnings were dropping, the Fed was drastically cutting interest rates. Makes sense. I talked about the mandate of the Fed, financial stability. That's one of the tools. When things get tough in the economy, earnings are being challenged, the Fed, their natural response is to lower interest rates. You can see on the far right here, the exact opposite is happening. It's because of inflationary pressures. With earnings rolling over and coming down, the Federal Reserve is still hiking rates. That's really not a great recipe to support earnings in a challenging recessionary environment. Do you want to talk about international stocks a little bit?
Yeah, we get the question a lot because we do own, as part of our stock portfolio, we own international stocks. And so why have that exposure versus just having the US? And there's a number of reasons. One, as you mentioned at the beginning, they did very well in the first quarter. They outperformed. But I think what you're seeing is that valuations actually in the international stock space are also better. So there's been a number of years now where there's been a divergence between U.S. and international stocks, and we'll show there's another chart here that I think is interesting that goes back and looks at the valuations of U.S. stocks versus Europe, and then you can see so U.S. being the blue line, Europe being the light gray line, and then it starts with emerging markets when that started being tracked. And for a long period, those somewhat coincided together. So they were tracking in terms of their valuations, and then starting really post 2008, the valuations diverged, and so U.S. stocks have been since then meaningfully more expensive. They've done very well, so it makes sense. I think now there's a lot of challenges in the global economy. In Europe in particular, you have a lot of geopolitical risk, you have energy crises, things like that. But to a large degree, that is already baked into the price. So it's something where going forward, even though there are those risks there, you're also starting from a lower level. So we think that's an attractive piece to have as part of a diversified stock portfolio.
All right, so let's shift gears and talk about gold. So why don't you talk a little bit about gold? Last year was flattish, somewhat disappointing.
Yeah, it was a little disappointing. And in hindsight, though, it wasn't that bad, right? So you had something where if it was flat in a year where, stocks were down high teens and bonds were down 13%, actually it was somewhat of a star from a performance standpoint.
Right. So in essence, I mean, theoretically, the more you had in gold last year where everything else was down, the better,
Right.
even though it was somewhat flat. And just to reiterate, one of the main rationales on why we own gold is, again, we think of it as a store of value. In essence, an ounce of gold today will buy the same amount of goods and services as it did theoretically 10 years ago or even 50 years ago. But in addition, I was listening to this really interesting podcast the other day where someone had a great line about gold. And what he said was, the beauty of owning gold are the risks you don't take by owning it. So again, I'll just say it one more time. The beauty of owning gold are the risks you actually don't take by owning it. And it's just such an interesting and simple concept that really resonated with me, because when you think about stock market risk, obviously gold is not exposed to stock market risk. When we're evaluating investments, we're looking at management team or maybe a piece of real estate property. The risks of that are not associated with gold. We look at fees that managers charge or structures. Again, gold is a store of value that is uniquely outside of all of those risks.
And so it's also simple in another way that we think of it, where because it's a store of value, it's really not meant to be an investment like, oh, I'm going to buy this or sell this, because we get asked sometimes of like, well, what's your price target, and trying to figure out a level. But this is something where I think you're looking at it saying more like, you don't think of buying cash, right? You're not going to go buy cash. It's just another currency substitute. And in that sense, it is very simple. It holds value over time. Mm-hmm. And so related to at what price point do you sell it? Look, if it has done very well. And so the first quarter has been really strong. It was up like over 10%. So it's not that we won't trade it, right? We're not going to shut our eyes and just hold it, let it become a huge percentage. But so we'll take gains if it makes sense as a percent of the portfolio. But ultimately, when you sell it, if something fundamentally shifts with our world and our government, where all of a sudden the government, starts with austerity and they're going to be aggressively saving money and very fiscally responsible, that would be a time you might want to shift your thinking.
We don't see that happening anytime soon.
No.
On that same podcast that I mentioned, I heard one other anecdote of when this individual will sell gold. And what he said is, when Kim Kardashian or Matt Damon are on a Super Bowl commercial like they were with crypto, professing the benefits of gold, I think that's when we'll know it's time to
That'll be a
exit.
good indicator.
All right, let's shift gears and talk about bonds. So bonds are having a strong year this year for the first time in quite some time. The bond index is up roughly 3%, and that's after a very challenging 2022, as you know, where bonds were down roughly 13%. I mean, that was something we were talking about a lot over recent years, avoiding long-term bonds, but for the first time in quite some time, last quarter, we really started getting excited about investing in bonds, where we felt we can make mid to even high single-digit type returns without taking on a lot of undue risks. So this was something we spent a lot of time talking about in the last webinar.
Yeah, and that was exciting, right? To the point where you looked at it and said, oh, look, I can invest in this and actually get paid a pretty attractive yield. Again, to your point, at a reasonable level of risk. So it feels like an attractive place to be going forward. Mm-hmm. On the more liquid side, again, there's good options. And then where we like a lot, which is the private lending side.
So let's shift gears. You want to talk about private lending? I know we just spent a little bit of time on bonds, but the punchline is it's a new asset class for us in a lot of ways that we're excited about. And we are actively allocating in a very different way than we did in years past. All right, let's move on to private lending. Let's go back, rewind back now to the bank issues. And their depositors have really fled regional banks to a large degree. They're taking their deposits out and shifting money into the larger banks, the JP Morgans and Wells Fargos of the world. So how does this affect our private lending opportunities? And maybe a quick reminder of what the private lending is, and then talk about how this regional bank issue is affecting private lending.
Sure. So in the public space, you can go buy a bond that's being issued by a public company and it trades on exchange. Private loans are still loans either on assets like real estate, that's our favorite, other kinds of loans, or it could be loans to a company, but they're private, so they're not something that's easily traded like that. And because it's private, you can often build in a lot more protections, controls than you can in public markets, just kind of taking what you get. Mm-hmm. And so now with the regional banks, I think what you're seeing is that the competition for these private lenders really went away overnight. And so they had a situation where these regional banks were their big competitors for the real bankable borrowers who were good quality, they had good balance sheets, really solid properties. If they wanted to get a loan from a regional bank, they could go and they could do it. And so now, because not even that all the regional banks are going to fail, but just because the depositors have pulled their money and they're under so much pressure, they have really stopped lending to a large degree. They've really halted all these activities. So now these really high quality bankable borrowers with really stable, good shaped properties are going to some of these private lenders to get their loans. And so you can now get higher quality loans and potentially higher rates for it.
Yeah, so can you kind of talk a little bit more about that? With that less competition, we are in essence getting better terms. So maybe even give like a simple example of the types of things we're seeing.
Sure. And so maybe before, if there had been a $10 million, a small apartment building that you would be lending on, the private lender would have had to have given them $6.5 million, and maybe they made 8% and a point or two on something like that. And so now they might get that for that. If you assume same value, though actually values have dropped, but let's assume it's that same value, you would basically maybe give them $5 million or $5.5 million, and you would get maybe 10 and a couple of points on the back end. So the rates have increased, and that's attractive. But I think that leverage point, basically how much they're advancing as a percentage of the value, is particularly important to us because, look, real estate, we're going to get to that in a minute, but real estate is not going to be immune from challenges. And so you want to have a really nice cushion built in. You can now make loans with bigger cushions at higher rates. And so I think that's a really attractive dynamic for this market.
So that's going forward. Can you just also talk a little bit about, this space has been tremendous for us. So how we've thought about the space in recent years, how it did for us even last year, but then also how we're looking to broaden access for our investors across this space.
Yeah, and like you said, this has been a great allocation for us. We really started moving into this space in a meaningful way post-2008 when rates were zero, but the consistency of it's been really made client portfolios very resilient. It's been a great tool for us. So last year, bonds were down, traditional bond index down 13%, and these strategies were up the same 7 to 8% typically that they have been in years past. So a lot of consistency with it. And so now it is the expanded access vehicles are improving. This is one area I think where we've always done a pretty good job getting a lot of clients exposure. But even there's a new fund that's come out that's structured a little differently. It's a publicly registered fund called an interval fund. And now basically everybody can buy it in their brokerage account for just a few $1,000s.
It's so exciting for us to be able to democratize this investment across a wider swath of clients.
It's really impactful. Like you said, our goal is to empower better investors. And so getting clients more exposure to these assets that we're excited about feels it's just great. I'm really excited. The structure of it is less liquid, right? So it's not a daily liquid fund. There's a quarterly liquidity window. So that has to be sized correctly for the client portfolio. But again, to get exposure to an asset class like this that we see as being very resilient is really exciting. We're working on more, so there's more to come. And we're seeing this broadly as a trend in the industry that people are trying to structure things so that more people can access.
Yeah.
We're working on potentially our own version of this to get access to more maybe non-real estate, private lending types of things. And again, it's exciting. It fits in with our mission. And so the more we can get of these kinds of things in the portfolios, the more excited we are.
All right, so you talked about private lending. Let's now talk more about real estate equity. And so by equity, I mean, you were talking about the lending side. I'm talking about ownership, which is typically higher risk, higher return, more liquid, but a core part of a lot of what we do. Can you start with, again, concerns we're seeing in the marketplace, specifically around different asset classes, what you're looking at?
Yeah, and right now with real estate, so real estate fundamentally is very impacted or more sensitive to interest rates than other asset classes potentially. So higher rates, there's obviously a watch to see what's going to happen to real estate prices. And so right now, at least, it is very specific to which sub-asset class of real estate you're invested in. So as an example, office is a very hot topic right now. It really never fully recovered post-pandemic, in terms of people getting to work from home versus in the office. So especially in some of the biggest markets, big high-rise office buildings are in trouble. And there have already been some headlines about big asset managers returning the keys to banks and things like that. So that's going to be a challenged asset, though again, specific to the exact situation. And so other asset classes, it depends on the specifics. Retail is an example. Also, people are worried about the Amazon effect. If you have a retail center with a grocery store as your anchor, that's almost a different dynamic. You have these high quality tenants. So it is very specific to the sub asset class, the location. You can't really be painted with a broad brush.
multifamily, generally speaking. How do you feel about multifamily?
I think it's more resilient in the sense that you've got, people have to live somewhere, right? So it's that fundamentally that demand isn't going away, and there've been a lot of news about dynamics there where the demand has continued to grow and maybe the supply isn't enough. That might be shifting, but it seems like that market's reasonably healthy, depending upon exactly which city you're in, essentially.
Back on the office theme, we have a lot of funds on the private lending side and the real estate equity side. Can you just comment on our exposure to office in general?
It's limited, so it's not that it's zero, but it is very limited. And where we do have the office, I think we feel pretty comfortable with the exposure, in the sense that, again, if you are in a city where you have a 2-story office building and it's fully occupied by really good quality tenants or mostly occupied, it's just a different dynamic than these huge high rises in the big cities, which are currently grabbing headlines. So it feels a little bit more specific to the situation. For the ones we do have, we feel good about it, and it is very limited.
So now, beyond asset classes, when you think about real estate in this current environment, potentially higher interest rates, higher inflation, what else are we thinking about, stress testing, concerned about?
I think with real estate, look, if you can hold it long term, I think it withstands a lot. We're concerned about leverage and interest rates, and were for a long time. There was a long period of time where we would talk to managers about fixed rate debt, and they basically told us we were crazy. And so if you are now in a position, though, with any of these properties where you have fixed rate debt, and so you've locked in your cost. Inflation is up, so in a lot of cases, the rents are still increasing, maybe not as quickly as they were, but you still have good cash flows. You're going to be okay. Like, you could ride through it. You're going to be fine. If now all of a sudden your loan's about to come due and you need to go to that regional bank to get a new loan, and the values probably drop, so you're going to get less from them, and your interest rate's going to be up big. Like, some of these properties aren't going to make it. They're going to be distressed, and they're going to be purchased from someone else who bails them out, basically.
Got it. Okay, so with all of these moving parts, let's talk about now going forward. What is your outlook going forward, both on the private lending side and the real estate equity side?
So I'm happy in terms of the existing asset classes. One, I'm happier with the debt, right, than the equity in terms of the conservative nature of that. So not the same return targets, but the flip side is, you've
much more resilient.
Much more resilient, big cushions built in place. So it's not that won't have any issues, but I think they're more potential liquidity issues versus the big blow-ups and things like that. So feel like there's some good resiliency on the debt side. And then on the equity side, we not accidentally are with a lot of managers who also favor fixed rate debt and are very thoughtful to not getting too extended in terms of leverage. They're not just trying to max out returns. They're thinking about risk management, wanting to make sure they're processing all of that. So I feel good about also the equity that we have currently. And then in terms of go forward, potentially if this gets nasty, there could be really good opportunities. So these people who now have properties where they cannot get refinanced, they can't get refinancing on their loans, they're going to have to sell. And if you can buy things at attractive lower prices, that's really where you make a lot of money on real estate, is during times of turmoil. If you can buy low, and sell high later, it potentially is a really good opportunity. And
we're with really wonderful partners who have shown the ability to be patient on the one hand, but then very opportunistic when the opportunities do.
Yeah, absolutely.
All right, thanks, Meghan. Really enjoyed this conversation.
Me too.
In winding things up, a ton going on in the markets and the economy of late. Still have elevated interest rates, elevated inflation, and even unpredictable events, things like bank failures that seem to happen out of nowhere. And with all of that unpredictability and enhanced volatility, our conviction towards diversification, it's really as strong as ever. And I think so much of that is around our belief that, our acceptance really, that the world fundamentally is an unpredictable place.
Yeah, and Silicon Valley Bank was a great example of that.
It really is. No one really predicted that happening in such quick order. And even beyond that, I think it's even an understatement. I think I would even say that we embrace the fact, not just accept, but really embrace the fact, lean into the fact that the world is unpredictable. So what is our approach with that? It's continuing to find resilient investments that really are going to stand on their own 2 feet in hopefully most economic scenarios that are thrown our way. Yep. So with that, thank you, everyone. Hope you enjoyed this market review.
Thank you.